Morning, Market Chameleons. Thanks for joining us on this Thursday morning. How you doing, Dima?
Good morning, Will. How are you?
I've got the disclaimer up. Great. I've got the disclaimer if you want to give it a go.
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer. And with that, I think we'll get started.
What's on tap for today, buddy?
So what I think we'll do is kind of go over some benchmarks, strategy benchmarks, and I'm going to discuss these benchmarks, especially maybe, revisit it. We talked about it, but, the calculation for implied volatility. And then after that, what if we're looking for certain types of strategies in an option, in a particular stock, how can I make a quick evaluation where the markets are? So that's what we'll go over, and I'll give some examples. I think that's the best way to do it. And if you have any questions, Will, let me know. You guys can put them in the chat, or if Will puts a link out there, if you click on that link that takes you to Zoom, you could raise your hand. And then we'll all be able to hear your question. You don't have to put on your video, but this way there are two different ways you could ask your questions. And before we jump to those examples, so we're going to take a look at different types of option strategies. It could be risk reversal, straddle, strangle, call spread, put spread. How do we just kind of get a sense right now where the markets are, and how they're setting up relative to historical levels? That's what we're going to do next. But as usual, let's just start out with the pre-market report, see what's moving in the pre-market hours, and then we'll jump to the benchmarks. So here, these are stocks that are trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Right now, we got 210 stocks that made our percentage gainers list, 38 on the percentage decliners. So from that perspective, looks like a bullish bias at the open. Let's take a look at, usually we look at higher market cap stocks. So I use this filter, higher market cap. Let's just take a look at the S&P 500. So I'm going to use this in ETF, and I'm going to look at all the components in the SPY. So SPY tries to mimic S&P 500. Let's select that. So in the SPY, right now in the pre-market, 43 stocks are trading higher, 4 lower. So from that perspective, it looks like a much more bullish bias at the open. If there are no questions with that, I'm going to start moving on to benchmarks.
Yep, you can move on.
Okay. So I'll use SPY maybe as an example. So I have SPY queued up. I'm going to go to the search. So right now we're on SPY. And let me first start out with this implied volatility 30-day IV. And, we discussed it, but I still get questions. Maybe it's from new people. Maybe some people forget. So sometimes I, get asked like, well, why is your implied volatility not matching up with what my broker is showing me? Like, why is this 17.3? My broker is saying it's whatever, 18.19 or 16.15. So why doesn't it exactly match up? And in implied volatility, okay, this is a 1 month implied volatility at the money. That's what this is, 30-day. Implied volatility it's a benchmark. It's not like a trade where you see, SPY right now, last trade for $439.26. So we know that trade, right? That is actually an actual observation. Implied volatility is not an observation. It's a derived value from option prices. Okay, and it goes through a model, and the model has assumptions in it, and the model is an estimated value. Okay, so it's not a formula, it's a model. That means it's how you calculate your model. And everybody's could be different, right? I am absolutely 100% sure that our model is different than what you're seeing from the broker, because there's no way that your broker knows the assumptions we're making and all the exceptions that we're taking out. And I have no idea how they're doing it. Okay, we're just doing it the best way we see how to capture implied volatility. So before, let me explain maybe by looking at the options chain. And here's an options chain. And where do the implied vols come from? Well, they come from option prices, right? Here's a bid and an offer. Here's a bid and an offer for different calls, bid and offer for different puts. There's a different expiration. And what is the implied volatility? So you kind of have to create that benchmark of where you think the essence of implied vol is. And the reason we do that is so we could kind of track, is it moving up? Is it moving down? How far away is it from the historicals? And that benchmark just tells us a little bit. Then we'll have to go in there and really then examine the individual options and strategies. So maybe to make it a little bit more clear, all right, just to make it, I created a notepad, what I mean here. And let's just say here we see this benchmark. It says the median price of used cars is up 10%. All right, so that's a benchmark, right? The median price of used cars. But what does that mean, right? So first of all, how do you calculate that? I could calculate it differently than you calculate it. So you get all this data and you get all these prices for median price. And let's just say, some cars are, 20,000, 15,000, 25,000, whatever, like this. So then, well, what happens when you're looking at the data? What if you see this $1? Do you include that in your data, or do you take it out, right? Because maybe somebody gifted a car, right? So somebody gifted a car and you're like, well, that's that's unusual, $1. Should I count that? Because if I count that, that could change my benchmark. And that's when I'm saying there's a methodology to it. Not everybody uses them. What about $5? Do you count that? $100? Do you count that? You have to make these types of decisions to kind of say, okay, this is how I calculate the median car. What if you have a different outlier? What if you have an outlier where you're like, well, how did I get this 50,000? Like, I get this 50,000 here. Do I include it? Do I have to check? Did it really go there? Why do I only have like one of those or two of those? So that's one way, you have to make a decision. What about used cars? What is a used car? You have to define it. A used car could be, is it between 3 years and 6 years? Or, where do you cut it off? Do you cut it off at 10 years? Is that still in the calculation? And if you're lumping up 10-year-old cars with 3-year-old cars, is it how much different is that are you getting a useful benchmark, right? So maybe you do between, 3 and 5 years, similar, because you want to get something similar, right? To get the essence. Because if you go from 3 to 20 years, this benchmark could get pulled down because maybe, all of a sudden nobody wants to buy a 20-year-old car anymore, so those just, are dragging everything down. So these are all decisions that go into a benchmark. That's why implied volatilities are not the same, because it's not published. We're calculating it, we're estimating it based on the observations, just like other people, and we're sticking to our methodology. I have no idea what other people's methodologies are. I'm just sticking to ours because that's where.
As far as the methodology, we did get a question on Zooms. I think it was from Jake. He was asking, could you specify what you assume is different in terms of inputs? For example, he's wondering what the inputs are into the model.
Yeah. So, like for example, just the IV model, right? Just the implied volatility model. Oops. Simple things like days to expiration, right? Are you calculating calendar days? Are you calculating business days? Are you Are you calculating, are you taking out holidays if the market is closed, or half days? Are you decaying your options throughout the day? Like if there's 2 days left, are you decaying, if you're at 12 o'clock, how many days to expiration are you using? Are you using full 2 days, 1.5 day? That's one way. Dividend assumption. What if you don't know what the dividend, they didn't announce the dividend, right? But you have to make an estimate. Are you estimating that it's going to pay the same dividend as the previous dividend? Are you estimating that they're going to increase or decrease the dividend? What date are you using? That's important. So how did you estimate your X date? Are you're using an estimate, trying your best based on all the information you have, but people are running different, estimated models. What are you doing for interest rates, right? So are you using the Fed funds rate? Are you saying that the Fed funds rate is going to remain the same for the next 6 months, a year? Are you thinking that it's going to increase over time? When do you think it's going to increase? By how much? What about what do you use as the data, or observations? How do you treat those, right? Because here, like we talked about here, what do you do when you see $1, right, in a car? So what do you do when you have to estimate the implied volatility from these prices? But what do you do if all of a sudden, in SPY, where it's normally 2 cents wide, goes no bid at $5? How do you handle that? Do you even skip that? Do you use a placeholder from the previous observation? How much weight do you give to each observation, right? So there's a weighting system, because now you're saying, okay, I'm creating a benchmark, and I don't have an exact at the money. I don't have an exact 30 days. That means I have to estimate it. How much weight am I giving it? Am I giving more weight to a market that's tighter? Like maybe this is 2 cents wide. This one is 4 cents wide. Do I give more weight to this than to this? These are things that over time you're putting into your model to try to really, get the essence of where the implied vol is. And that's why somebody else's implied volatility will be different than ours, because they could use whatever methodology they want. It's up to them. We don't control it. We just control what we see, So I can't tell you, well, theirs is different because, their cutoff is, $100, right? So they'll include a $200 car, where our cutoff is maybe, 3 standard deviations away. We cut those off, or anything above 4 standard deviations. I don't know how they do it. They could be using, between 2 and 10 years, where we could be using between 2 and 5 years. These are the differences, and that's why their benchmark could be different than our benchmark, and the change could be different because they're looking at a different data set. So it's a methodology. It's very important. People look at the implied vol. Some people are just telling me, well, you're just wrong. This is not correct. Why is it's not correct? Because obviously my broker has something different, so yours is wrong. I'm like, then you probably don't understand how implied volatilities are calculated, because there's no such, it's a methodology. It's not, you could have wrong data maybe or something, but is it wrong, if you use 3 to 20 years or 2 to 5 years? This is just basically how how you create your benchmark. So that's one thing kind of to keep in mind when you're looking at implied vols, and you're if you're using them, you can't. So the thing is, when somebody's consistent with their methodology, you could kind of just compare. You're like, okay, it's going up, it's going down, because you're consistent with the methodology. But to try to compare benchmarks across different platforms is not really possible because you're using a different methodology, right? You're using it's being estimated different, right? And there could be lots of different factors.
That was great, D. We had a question coming across the YouTube chat from a new chameleon, Trevor. He's asking, could you explain the bid IV and the ask IV on the option chain?
Yeah. So right here, I'm on the options chain, and how are implied vols calculated? All right. Well, the implied vol is calculated the following. The model needs assumptions. So the model will say, okay, you have this option, October 18th, expiring. We've got 8 business days. I got the 44.39 strike. So I gave them the strike. I get the spot price, interest, dividend. Now I need an option price, right? So they're saying based on the option price, this is the implied volatility. Well, here's a call. All right, here's a call. And I have 2 different prices. I have a bid and an offer. So which one do I use? Right? So the bid if I use the bid, this is the implied vol, 15.8. If I use the offer, so these are close because these markets are pretty tight. Here's one a little bit different, 15.2, 15.3. We're rounding it to the nearest decimal. So I have 2 different prices for an option because there's interest to buy it at one price, there's interest to sell it at another price. And I don't know, maybe here, let's go to a wider market. What's a stock that has that's very volatile? Maybe Netflix, maybe. Let me take a look. So maybe Netflix, has a little bit wider markets. It's higher price, moves around a lot. So now you could see here, $2 wide markets. So I got 36.5 on the bid, 38.2 on the ask, and that's just in this one option. So the model needs a price, right? Which price do you use? Do you use the bid? Do you use the offer? Do you use the midpoint? How much weight do you give, to each one? So the benchmark, we use a weighted average of the strikes around the spot price, right? Around the spot price. So we're looking at these, all these, and then we're giving it a weighting based on, well, where's the market tighter? Wider markets get less weight. Sometimes put gets more weight, sometimes calls get more weight. It all, there's a algorithm in there doing that, but it's consistent. So we're following it throughout time. So this way we could compare it, going back in days using the same consistent methodology. But that's what I meant by price. What price do you give it, right? You're not going to give it, and the price you're giving it is the current bid, the current interest somebody's willing to pay you, and the ask is the current interest somebody's willing to sell it to you, right? Because a lot of remember, options are not like stock. Like, stock moves on every trade. The options are just a derivative. They're following the stock price. So you see here, there's no volume in all these. There's no volume, but the bids and offers are changing, and they're changing dynamically based on price, implied volatility, decay, all that is going on. And that's how we're recalculating. So hopefully that kind of gives an idea of people, like why benchmarks cross, you're not going to see the exact same implied vol if you're just comparing. Now, a print like a stock price, you should see the same, right? Because a stock price is just a data point, right? That's stock price is a data point at a given time. That should match up, as long as you're matching up at exactly the same time. But an implied volatility, that is an estimated value derived from an option pricing model. Any questions with that?
Yeah, that was helpful, D. Robert was asking when you were He was asking about seeing standard deviation moves. Is there a spot? I know we have one standard deviation move on the options
Right.
chain. He was wondering if you can.
Yeah, well, so if you click on here, this is one standard deviation and just kind of highlights the strikes, that one standard deviation move down and up, represents. But a straddle options, that's what it is. It's estimating standard deviation moves, right? That's what you're trying to estimate. That's what the option pricing model. So if you go kind of here to the activity, so under here, the activity, these are different expirations, right? So these are different expirations here. These are the days to go, right, for each expiration. This one has 2 days to go. This one has 7, 12, 17. So, these are business days, the trading days left to expiration. So what we're seeing here is, what is the straddle? This is converting the options to a straddle. What is a straddle cost? So October 8th, 2.1%, October 15th, 4.1%, 8.1%. So this is a standard deviation move up or down, right? That's what the straddle is. So remember, as you go out further in time, you have more time for the stock to move, so the standard deviations would be different. So you could look at it that way, or you could just kind of see, you go to the expiration and you're like, well, what's a estimated standard deviation move up or down? You click on this, and then you could kind of follow those strikes. 720 to the upside, 560 to the downside for this expiration. Is that helpful? Hopefully, hopefully you guys got that.
Yeah, that was helpful. Thank you.
Okay. So let's see. We have 8 minutes left. So I'll go back to hopefully, just to clear that up. Hopefully that cleared some of the questions up. Now, I'm going to go to SPY, and when we see a 30-day IV, right, we see an implied volatility, we kind of could see like, okay, this is its rank versus historical. So this is telling us 64% of the daily observations in the last 252 days were below this level. Okay, so it's on the higher end, right? Because now we get 36% were above, 64% were below. So it's still within the range, but 64% below. But that doesn't help us kind of evaluate strategy, or and this is for 1 month. So this doesn't help us really if I'm looking at to do a risk reversal or a spread, right? Or maybe a calendar spread or a strangle. Doesn't really help me because this does not compare, other options relative to each other. The IV doesn't tell me really like, well, how does this option compare to this option if I wanted to do a put spread, right? Or if I wanted to sell this option and buy this option, the IV doesn't tell me, because even if the IV is elevated or moderate, if I'm spreading my risk off by doing a strategy, buying and selling, then this doesn't help me that much, right? So that means I'd have to compare these options relative to each other over time. How did they, on average, how do those premiums compare versus each other? And that's why we have to use different benchmarks to do that. And I'll give you an example here. These are strategy benchmarks here. We have a summary here, but then we also have, moving along to different types of strategies. So these are the more popular strategies like risk reversal, straddle, strangle, put spread, call spread ratio. And if you go through, you could kind of go through them, and you see we help put up a lot. Iron condor, iron butterfly, long put, long call. So this kind of gives us a different way to look at it. and here, for example, I clicked on strangle. So strangle, it's not at the money. Now we're looking at wings. Well, how did the wings compare, right? So, am I on strangle? Yep. So how do the wings compare? So here we have to benchmark, right? So what is a wing? Is a wing 5% out of the money, 10% or 12%, right? So people could have different wings. So here we benchmark a 1 month out, and 5% out of the money call, 5% out of the money put. So it's looking at, if you're buying both of them, right? How much on average did it cost you? So in the last 52 weeks, it would have been equivalent to 1% of the spot price. Okay, so whatever this spot price is, take 1%, and that's how much you would have been paying for the call and the put, right? Because as the stock moves, obviously the premiums, they're all moving with it. The lower the stock price, the lower the premium, so we calculate it as a percentage of spot price. So you'd be paying equivalent of 1% in the last 52 weeks. Right now, it's 0.9. So this is actually below, right? Even though here we go, we're moderate, but that strangle is below the 52-week average. And you can kind of see here, this is the history of it, right? And that could go down. There's more. What about a 2-month strangle? Again, here we're benching at 5%. Right now, it costs you 2.1% versus historically 2.2. And now I could even compare the 60 versus 30, right? Just right here, on average, the difference was 1.2%, right? Really quickly. And now I could see it's right there, 1.2. So it's right near the average. They're just both a little bit lower. Or I could compare the 90 versus 60 and so forth. So that's why we're using benchmarks to make relative comparisons, all right? So this is buying both. What about risk reversal? Risk reversal is within the same month, right? I'm buying one. So you're buying a call, 5% out of the money, selling a put, 5% out of the money. Here we see we're getting a credit. So what this is telling me is that the put price, 5% out of the money, is more expensive than the call price that's 5% out of the money, right? Because if I'm selling the put and buying the call, receiving the credit, that means the put is priced higher. Well, we see that's normal. Usually that's the case in SPY, but right now it's a little bit higher than usual, 0.7% instead of 0.6, right? So this is, and you could see historically how it fluctuated around the average and how far it got, right? Because sometimes you want to look at, well, how far away, how extreme is it from that mean? Okay, so we could go down, look at a 2 month, 3 months, or 4 months, I think, over here. So these are quick benchmarks to reference depending on what you're trying to do. But the idea here is, why do we look at the benchmarks? Just like implied volatility, because if we have in mind a strategy that we want to do, it would be very hard by just looking at the options chain, right? Just looking at the options chain, it would take you more time to figure out, oh, well, if I sold this, bought this, I got to set it up, I got to first set it up, and then, which takes time. I just sold a put, let's just say, whatever, I'm buying this call, then I got to run this, I'm getting a credit. Historically, then I got to go look, I'm getting 19 cents credit versus 1, so that's pretty good. So before I go and try it, I could look at my benchmark just to get an idea, the sense of how the markets are lining up versus historicals. Okay, and then I could say, okay, this looks interesting. Let me go to the options chain and start setting it up. So we're right up at 9:30. Hopefully this was helpful. I don't know.
It was, Steve. We did have a couple questions. Maybe you can get to them tomorrow. Someone was asking about Theo. If it's red, is it overvalued? If it's green, it's undervalued. Someone was asking about that. And another, I think it was maybe Trevor was asking, any reason you're using plus or minus 5% in the benchmarks? So those were two questions maybe we can get to tomorrow. Thanks so much, buddy.
All right. Well, thanks everyone for joining. You know, have a stay safe out there. Have a good trading day. Just really quick, the 5%. That's the first benchmark, but just so you guys know, you guys could go in here. There's other ones. Remember, you have to pick, right? You have to pick one. 5% seemed like that's the first distance, but you guys right here, if you wanted to do it yourself, you got 1%, 2%, 5, 10, 20. All right. So you could run your analysis differently if you wanted to, but again, some way you have to benchmark where you think it's reasonable. You know, I think benchmarking 30% is too far, just like saying, you know, which used cars do I want to use? If you use 20 years out, it's already maybe unreasonable, right? Maybe, and maybe because there's not enough volume in those, you know, people that, you know, where do people, the core of the trading happens, right? The core of the trading, that's kind of how we start benchmarking. So if used cars, the core of used cars is like between 3 and 5 years, that's kind of leads you to where you want to start looking, right? If that's where most of the volume is, maybe 20 years, you know, you only have 1% of the volume, maybe just exclude it from it. That's why we start looking at 5%. When you start going out from at the money, that's kind of where the next, you know, level of volume is clustered, right? And that's why we're starting to look at it. So it's kind of data driven, you know, but you have to pick it, you know, why not 6%, 5%, you know, that's the number kind of you know, why not 5.5%? It's close enough, right? We picked a good 5%.
Perfect explanation, my friend. All right,
okay.
We'll see you tomorrow. It's Thursday, one more day of the trading week after today. We'll see you tomorrow morning, 9 a.m., same time. Thanks, D.
Awesome. Thanks, everyone.
Trading.